Hello, my name is Courtney Talbot, and I am here with Thrive Consultancy to talk to you about Introduction to Worker Cooperative Finances. We at Thrive are working to develop the ecosystem around cooperatives in Arizona to support cooperatives that decide to start business in Arizona. And so today I'm going to give you an overview of some financial statements and the specifics for those in those financial statements for worker cooperatives. So let's go ahead and get started. The first thing I want to mention, this is an informational session just designed to help you understand more about financial statements for your cooperative business. I am not an attorney and I am not a CPA, so this is really information just to help you understand things a little better. None of this should be construed as legal or tax advice. Please consult an attorney or a CPA if you have additional tax questions. All right, so some of the key topics we're going to go over today are cash basis versus accrual, and exactly what that means. We're going to review 3 different financial statements that are universal to all businesses, but then we're going to point out some differences that a worker cooperative might see on these statements. We're going to go over equity, profit and surplus, and patronage, ownership, dividends, and shares. I want to point out that the context for this is a worker cooperative business model. And if you're not familiar with that, worker-owned cooperatives are values-driven businesses that put their workers and the community benefits at the main core of their business purpose. In contrast to conventional companies, people who work at worker cooperatives participate in the profits, the oversight, and the management of the entire business using democratic practices. If you have more questions on that, please see some additional Thrive training to understand more about worker cooperatives. Okay, let's get right into it. So one of the basic financial tenets of bookkeeping and understanding financial statements is understanding the difference between cash basis and accrual basis. This is really the time that various financial transactions are recorded. In a cash basis, income is recorded when that money is actually coming into that bank account. Or conversely, expenses are recorded when the money is coming out of the bank account. That's the only time you're recognizing something, when money is coming in or money is going out. An example for this would be a check register. You're only writing in that check register when you pay something or when you receive something. Accrual is a little different. In accrual basis accounting, income is recorded when you actually are recording the sale. So for example, when you issue your customer an invoice, that is when that income gets recorded. Even though that money may not quite be in your bank account, you may give your customer terms to pay their invoice, which maybe is 10, 15, or 30 days, but you're recording the income the time the invoice is issued. Invoices like that would stay in an accounts receivable account until they are paid. Expenses are recorded when that expense is incurred. So for example, when you get a bill from your vendor, that would be when you record the expense. Even though you may not pay it right then, you may pay it later. Invoices stay in an accounts payable account until they are actually paid. An example of accrual accounting you can think about is a credit card kind of, because essentially, those charges are accumulating and they're not being paid right away. Some businesses may have a hybrid of these two. However, it's typical for smaller businesses that are doing cash on demand, such as small restaurants or cafes, things like that, are using cash basis. Other companies may use accrual. Again, the indicator there is usually if they have accounts receivable or accounts payable, meaning items may not be coming in, either coming in income or being paid out as expenses when they are incurred. There's some resources on this. I know it can be a complicated topic, but you can read more about it using the resources that we're going to provide. Okay, and here's a little table to just further explain these two differences. So notice on the left-hand column, those are the actions and then what they mean in cash basis versus accrual. So again, when income is recorded on a cash basis, when that money is actually in the bank account. But accrual basis, it's when the sale is made or the invoice is generated and sent to the customer. One more time, expenses are recorded on a cash basis when that money actually comes out of that bank account, not before. And in an accrual basis, the expenses are recorded when the invoice is given to you from your vendor. meaning that expense was incurred at that point but may not be paid yet. You can notice a difference on the chart of accounts for accrual basis accounting because you will notice accounts receivable and accounts payable on your chart of accounts and then on your financial statements. Those accounts are not usually on financial statements for a company that's using cash basis. And here's our two examples again. A check register is an example of a cash basis. You're recording those items when the money's going out or coming in. And accrual basis is kind of like a credit card because those expenses and potentially credits or payments are not actually being paid when they're incurred. They're being paid at a later date. Okay, so now that we kind of understand two of the different ways to recognize our revenue and expenses, let's talk about financial statements. As I mentioned in the very beginning, financial statements are universal to all companies. They might look a little different depending on if they're using cash basis or accrual basis, and they may also look different depending on the type of company. They really are telling a story with numbers, and the information provided in them is useful in relationship to other information. So, financial statements are great for making comparisons about your business, both over time and within the financial statement itself. The most useful comparison for these financial statements is with reality, and we should always be looking at these statements and having some dialogue about our operations in real time. So, for example, when you're looking at your financial statements, some of the questions you can answer are, does this statement confirm or explain experiences in running the business? That could be with expenses, it could be with revenues coming in, but does what the statement is telling you fall in line with what you've experienced in the last few months of running the business? What questions do these financial statements answer? If for some reason you are always lacking in cash, but you feel like you should be making a profit and have more cash, these financial statements can hopefully tell you a little bit about what's going on. What questions does it suggest? Maybe something on the financial statements looks funny to you. It's not something you were expecting to see. That's why regular review of your financial statements is so important. And the last point, what data is missing? Once again, if you know that you've had a large expense or a huge sale that's come in and you're not really seeing those numbers as you think they should be on the financial statements, maybe something is missing. Another thing I want to point out is financial statements are based on all of the bookkeeping entries that are done over time. So the more accurate those bookkeeping entries are on an ongoing basis, the more accurate your financial statements are. So again, some of these questions, what data is missing, what questions does it answer, we need to make sure that our bookkeeping procedures are followed and are accurate so that we can trust the information that's on our financial statements to help us answer some of these questions. Okay, so here is a breakdown of the three main types of financial statements. And this is a basic breakdown, but it gives you an idea of what is on each one. These colors are going to flow with us through the rest of the presentation to indicate these different financial statements. The first one I want to go over is the profit and loss statement. This is also known as the income statement. Profit and loss is also often shortened to P&L. All of those terms are interchangeable and can be used to explain the specific financial statement. So what you'll see on a profit and loss or income statement is an overview of the revenues and expenses. And you'll notice two things on a P&L as well, gross profit and net profit. Revenues can be from the sales of products and services, but can also be other revenue items, such as if you sold an asset, or maybe you're getting interest on something, maybe money sitting in a bank account. Those are other forms of revenue. Grants can be considered other income and may be taxable depending on the type of grant. Expenses will be both cost of goods and services, as well as ongoing operating expenses. All of those can be seen on the profit and loss, and the bottom line on a profit and loss is called net profit. The balance sheet provides an overview of the company's assets, liabilities, and the shareholders' equity. Assets are items of value that a company owns. We'll get into some specifics later, but this could be things like cash, equipment, or real estate. Liabilities are things that the business owes or has borrowed and needs to repay. So for example, If you have an asset of a building, you might have a mortgage tied to that. The mortgage is the liability that you owe someone else for something. Liabilities can also be short-term loans, notes payable, things like that. Again, things that the business owes. Equity is a company's net worth or the amount that the shareholders would get if the business closed after paying off all its debts. Essentially, assets minus liabilities would equal the equity in the company. The final financial statement I want to go over is the cash flow statement. This tracks the inflow and outflow of cash. It is complementary to the balance sheet and the profit and loss, and it can be very important for companies who use the accrual method of accounting. Because the accrual method is only recognizing items when the sale is made in the case of revenue or when the expense is incurred, that doesn't always point to the cash flow of the business. So the cash flow statement can be very important to see exactly what cash is coming in and going out. And using that is complementary to the profit and loss statement to see what is being recorded in each month. Okay, let's get into the specifics of each of these. Oh, here's some examples I had completely forgotten. I got these examples from an accounting textbook called Accounting Principles, the 14th edition. These are corporation examples, but again, as I mentioned, financial statements are universal to all companies and businesses. So these are really good examples of what these things might look like. So on the right-hand side, we have a balance sheet. The example here is from Franklin Company, and you can see various areas here. The top part is assets. Notice some of the current assets they have there. Cash, we've mentioned that. They have some debt investments, some accounts receivable, some notes receivable, meaning people owe them some money. Inventory is considered an asset as it's something worth value the company owns. And then notice they also have some property, plant, and equipment, and also some intangible assets. Intangible assets are going to be things like patents, intellectual property, things that cannot actually be touched or felt. Then the next section of the balance sheet is where those liabilities and the equity comes in. It's important to note that a balance sheet must always balance. You're balancing the assets, so in this example, that's $61,400, with the total of liabilities plus owner's equity. And notice at the bottom, that also equals $61,400. It's very important that those pieces match. The balance sheet must balance. So under liabilities, there's some things that I've already mentioned: notes payable, accounts payable. Those are indicating items that that company still owes. It owes money on a note, probably a loan, and accounts payable. It owes some of its vendors some money still. Then there's some long-term liabilities. For example, a mortgage payable. That's definitely going to be a long-term, as a business is something that a building is something that is paid off over a longer term. Typically, current liabilities and current assets are those which will be used within 1 year. Long-term liabilities would be over a year. There can be an intermediate form of liabilities. That might be things like vehicles, which usually you get a loan for 5 to 7 years for some equipment, but long-term liabilities are going to be things that are much more than that, again, like a mortgage that's usually 20 or 30 years or 15 depending. A note payable is under long-term liabilities. That's likely something that's being paid on over 1 year. And then we have the owner's equity at the bottom. And again, liabilities plus owner's equity, that total should equal this total of the assets. You can look at this later. Again, this is not what every company's balance sheet will look like, but it's a good example of one that has a lot of different pieces in it. On the left-hand side, we have an example of an income statement. Notice we're seeing things like sales, cost of goods sold, operating expenses. Once again, the profit and loss is your revenue and your expenses to result at a net income. It's important to notice that cost of goods sold is up towards the top right after sales. Sales minus cost of goods sold gets us a gross profit. The gross profit can be thought of as the amount of money remaining after all of our direct costs are accounted for to pay for everything else. Operating expenses are things that are common to a lot of companies: salaries and wages, utilities, advertising, Depreciation expense is on here, but I want to point out that is a non-cash expense. So when we look at the cash flow statement, you will not see depreciation, but it is an expense that needs to be accounted for. Other revenues and gains, as you notice down towards the bottom, can be interest revenue, or as I mentioned before, money coming in from sale of assets or other non-operating income. And what I mean by that is if you're getting money from something that is other than your normal sales. For example, in this company, they usually probably don't sell assets in their normal course of business, so it's under other revenues and gains. And then we have some other expenses and losses. Again, these might be things that are not occurring all the time. For example, they have casualty loss from vandalism. That's not something that they're accounting for all the time in their operating expenses, so it goes down towards the bottom as other expenses. And then we see a net income, which is just our revenues minus all of our expenses to arrive at the net income. That could also be a loss if our expenses are more than our revenue. Again, this is not what every company's income statement will look like, but it's a good example of one. Let's go on to an example of the cash flow statement. This is a cash flow statement example from the same textbook I mentioned, and it's for Chicago Corporation. And notice it has a couple different areas. It has cash flows from operating activities. If we go down to about the middle of the page, cash flows from investing activities, and then cash flows from financing activities. Not all three of these cash flow activities will always be occurring. This is an example of a company that is using all three, but that may not be what your cash flow statement looks like. Again, a cash flow statement is only indicating those cash flows coming out and going into a business. It's very important to notice that this can be very helpful if you're consistently noticing you don't have enough cash at the end of the month. You might want to take a look at this statement and see why that is. Maybe there's something that you've forgotten that keeps coming out that you're not aware of. Any accounting software should be able to provide a cash flow statement for you, and it's important to get used to looking at all three of these financial statements on a regular basis so that you start to understand the ins and outs of your specific company. Again, these are examples provided by a textbook. If you'd like to look at them a little further later, you can download the PDF that accompanies this presentation. Okay, so now let's get into exactly specifically what's going on inside those financial statements. Try to break this up so that it makes a little sense. This is the profit and loss or income statement. So we just saw an example, and now this is a simplified example to kind of explain exactly what's going on here. I want to point out that profit and loss is a statement that is generated for a specific period of time. So this example is for the first quarter of 2023. So all of this, the information that would be in a profit and loss would be for that entire period. So notice first we have our sales and revenue. Again, simplified in our example, but we take our sales and revenue, we subtract our cost of goods sold to equal our gross profit. Then we take our gross profit and subtract all of our operating expenses to get our operating income. Then we continue going down, taking our operating income and subtracting interest, tax, depreciation, and amortization, which equals net profit. Depreciation is something that is used to reduce the value of an asset over time. There's depreciation schedules that CPA can help you deal with. A CPA is usually someone who's going to calculate this for you, as there are different methods to depreciate different assets. Amortization is the same type of mechanism, but it is used to reduce the value of non-physical assets. For example, intellectual property. Intangible assets is what amortization is related to. So once you take interest, taxes, depreciation, and amortization for the period, we subtract those from our operating income to arrive at our net profit. Could be a net loss as well, as I mentioned, if our sales and revenues cannot cover all of our costs. Okay, let's move on to our balance sheet. Unlike the profit and loss statement, a balance sheet summarizes a company's assets, liabilities, and shareholder equity at a specific point in time. So notice in our example here, it says balance sheet as of March 31st. The balance sheet is a cumulative statement. So as of March 31st, these are the balances that you would be seeing. So this is a simplified example from the one we saw, but the components are still the same. We have our assets, and then we have liability and owner equity. And once more, a balance sheet must always balance. So the total assets must equal the total liabilities plus the owner's equity or shareholder equity. Those terms are used interchangeably as well. So assets, let's start with assets. They are what a company owns, remember? And they can be current, used within 1 year, or long term. As I mentioned, there can be intermediate assets, but generally it's just current or long term. Some of the examples could be cash, accounts receivable, because that is money that your customers owe you, so it's an asset to you. Inventory, those are things the company owns. That is considered assets. Property, plant, and equipment, we went over this a little bit. All of those are things that a company owns and is using. And vehicles can also be assets as well. All right, let's move on to liabilities and equity. So liabilities and owner equity can be thought of as how the company is paying for their assets. So for example, if you have an asset that's a building, you might have an associated liability that's helping you pay for that in the form of a mortgage. So liabilities are obligations between one party or another not yet completed or paid for. Similar example or similar definition to what we saw before, they can be things like, again, wages payable. If you owe employees something for some reason, that's a liability to you. You have to pay them. Interest payable, that's also a liability. If you owe interest and maybe you only pay quarterly, it will sit in a liability on the balance sheet until you pay it. Unearned revenues is also one. The reason that is a liability is because you might have that revenue, but you have not earned it yet. So you recognize it when you earn it. If you need more information on unearned revenues, talk to a CPA. It can be an interesting topic. Debt is also a liability, as we've talked about. So taking on a loan, whether that's long-term or short-term, that's a part of a liability. Equity. That is going to be money attributable to the owners or the shareholders of the company. And retained earnings is also listed on the balance sheet under the equity section. This is the net earnings a company has accumulated over time. It can either be reinvested into the company or used to pay off liabilities or debt. Retained earnings, I want to also mention, is made up of the net earnings, as this says, accumulated over time, and where that number comes from is the net profit from the profit and loss. So the balance sheet is an ongoing statement that is accumulating over time. The profit and loss statement essentially is for a certain time period, most of the time a year, either the fiscal year of the company or a calendar year. And when that time period is closed, whatever net profit or loss is left on that profit and loss statement comes over to the balance sheet on the retained earnings portion. So that is how it's accumulating over time. Retained earnings can either go up or down. If there's a net profit, retained earnings will go up as it accumulates. Or if there's a loss, the retained earnings will go down a little. So retained earnings is also, if you were going to do a distribution to your shareholders, it would come off the net profit prior to going to retained earnings. If you need more information on retained earnings, there's some resources in the PDF of this, as well as you can talk to your CPA. One more reminder, for our balance sheet, total assets must match with the total liabilities and owner equity total. If your balance sheet does not balance, you have an issue somewhere. Okay, let's move on to the cash flow statement. So this is a statement, as I mentioned, that summarizes the cash coming into and out of a company. It's complementary to the profit and loss and balance sheet. So a couple things I want to point out. Cash is not the same as net income or profit. That's a very common misconception. But it sort of makes sense that they're not the same because they're seen on two different financial statements. Cash, if you recall, is an asset. It shows up on the balance sheet under our assets. But on the profit and loss statement or the income statement, we see net income. So two separate things, okay? That's why the cash flow statement is very important, as I mentioned, for companies using the accrual method, because using the accrual method is not the same as showing the cash flows. The cash flow statement does not include the amount of future incoming and outgoing cash that has been recorded on the profit and loss. Remember, it's just the cash in and out during whatever period you're specifying. The last point down there reiterates what I said again. If a company is using accrual method, there will be a disconnect between the net income and the actual cash flow. So a cash flow statement will be very useful to help monitor the cash position of a business that relies on accrual method, which again is going to mean they have accounts receivable and accounts payable, which indicate they may not be getting their cash when the sales are made or when the expense is incurred. Let's go to the next slide. Here are a couple reminders of things that can affect cash flow, but may not be on a profit and loss. So for example, transactions that affect cash flow, but are not on the profit and loss would be equity contributions. For example, maybe one of the shareholders says, well, I have some extra money that I would put into the business. That is going to increase that's going to increase our cash, right? But that's not going to go anywhere on our profit and loss because our profit and loss is just for revenues and expenses. An equity contribution by a shareholder is neither of those. Principal payments on debt. That's not going on your profit and loss either. It's coming out of your cash likely, which is on your balance sheet, and it's being put towards one of your liabilities, which is your loan, your debt, okay? It doesn't touch the profit and loss. An equipment purchase as well would not be on your profit and loss statement. It's going to reduce your cash and it's going to increase your asset of your equipment possibly. Or if you're financing an equipment purchase, you're going to increase a liability, but you're going to add an asset. All of those things happen on the balance sheet, not the profit and loss, okay? I'm going to just point out again, the more familiar you become with all of these financial statements, the more a lot of this information will make sense. So really practice reviewing your financial statements at a regular basis so that you can become more familiar with them. Okay, a couple other things I want to point out. There are certain transactions on the profit and loss statement that do not actually affect cash flow. For example, when invoiced income, so accounts receivable. On the profit and loss, you're going to see all the sales made within 1 month. But if you have a net 30 payment terms for your customers, none of that is going to be cash until the following month. So there's no cash flow to tie to that. Billed expenses are the same. If you look on your profit and loss and you're using the accrual method, you might see a lot of expenses there. You've probably gotten invoices for them, but you haven't paid them yet. So there's no cash transaction. And the last one I want to point out is depreciation. I've already mentioned once, but depreciation is a non-cash expense. It is an expense as it is reducing the value of an asset over time, but that is not a cash transaction. So you will see that on your profit and loss, but it will not be on your cash flow statement because there is no cash movement anywhere. Next topic, let me just pause for a moment because all three of those financial statements are very important. And remember, they're telling you a story with their numbers. So in order to really kind of decipher what your financial statements are telling you, you can use financial ratios. These are just a few of the ratios, but we have included some resources that have a lot of different ratios you can use. Ratios may or may not be important depending on your industry. So some of these might apply to you and some might not. You might want different ratios in your company to kind of compare yourself. But let's go over these 4. And I want to start with the question that they're asking. So the first one, current ratio. The question that it can answer is, could you pay your current debt tomorrow? And essentially what this is saying is of your current assets, what is the ratio of your current assets to your current liabilities? You can find this information on your balance sheet, and you can calculate these ratios on your own. Saying this current ratio in words would mean for every $1 of liabilities, you have X amount of assets. Again, once you divide those, you would get a ratio. A note there, if you have a ratio in the current of over 1, it may indicate that your debts coming due in a year or less are bigger than the assets you have available to cover them. Some of these may be confusing. As you get more involved and more confident with your financial statements, these ratios will start to make more sense. Let's go down to the next one, labor to sales ratio. This is answering the question of how much labor do you need to produce your sales volume? So you would take your total labor divided by your total sales. And what that says in words is for every $1 in sales, you will need X amount in labor to support that. Okay? The third ratio is just the percent change. So this can answer the question of what has increased or decreased over time. This could be anything you want to see on any of your financial statements. You can use this formula for. So you would take something, maybe it's your sales. This quarter sales minus last quarter sales divided by last quarter sales would give you a percentage of change from one quarter to the next, or a month or year, whichever time period you want to look at. The last one I want to mention, and again, this is just a selection of ratios that might be helpful. This is not all of them by any means. Percent of sales can answer the question, what is your sales breakdown? Maybe you have several different types of things you're selling and you want to know what is bringing in the most sales. You would take that sales type divided by the total sales to find the percentage of a specific sales type in relation to your total sales. Okay, again, this is not an exhaustive list, just some suggestions. The more you understand your financial statements, the more these ratios will make sense and you will be able to use them efficiently. Okay, so now that we've explained the 3 different financial statements, and again, these are financial statements that any and all businesses should use. Now I want to point out the differences that you would see on a worker cooperative financial statement, specifically the balance sheet. The profit and loss should remain mostly the same, but the balance sheet, and specifically the equity section, is where you'll notice a difference. So the equity section of the balance sheet will be made up of the worker-owner equity accounts in a worker-owner cooperative. What those accounts represent is the amount of equity each worker-owner has in the company. Another difference, retained earnings on a balance sheet are generally lower for cooperatives. This is because the worker-owners get paid some patronage out of this retained earnings. There's an implicit relationship between labor costs and patronage for worker, or which is also known as worker-owner equity in a worker cooperative. For example, in a worker-owned cooperative, patronage is based on the number of hours worked. So if your labor costs are going up, your patronage will likely go up as well. Okay, let's see some other differences or more explanation. So worker-owner equity accounts, as I mentioned, are listed on the balance sheet. They're made up of 2 different things. The initial buy-in that's required, which is a requirement for a worker-owner to become a worker-owner. And then it's also going to be all the retained patronage that a worker-owner is given throughout their time with the cooperative. So think of patronage as an ownership dividend. Sometimes you might see patronage dividend used instead of, but they're all sort of the same in a worker-owned cooperative. They are treated the same. So how this works is that, wages are paid throughout the year to worker-owners as workers. They work, they get paid. But then at the end of the year, if there is a surplus, and we'll talk about that in a minute, it is distributed to worker-owners as the owners of the business. So patronage distribution to worker-owners, part of it, minimum 20% per the IRS, must be paid in cash. We'll discuss this in a minute. A couple other things. Part is usually retained by the cooperative, and it's put into those member capital accounts or equity accounts. Those will be used interchangeably as well, those terms. Okay, and so that's what you see on the balance sheet of a worker cooperative is those different accounts for all the different worker owners. The rules for the patronage are generally laid out in the cooperative bylaws. So it's very important that everyone understand what is in the bylaws and how patronage is being distributed. Typically, worker owners are taxed on the entire patronage distribution, whether paid out in cash or retained by the cooperative in the worker owner's capital or equity accounts. I'll explain this in just a moment. So this is the basic idea of how patronage works. Again, this may be different in each cooperative as the cooperative bylaws really are driving this process. Okay, so we're going to go through a little example of how we would distribute patronage. As I mentioned, the bylaws will really drive this process. So in this example, I'm going to go through ABC Cooperative is the name of our cooperative. And here is their profit and loss for their fiscal year 2023. They used a calendar year, so that is when this is done, at the end of their calendar year. So notice we have some information over here. Again, very simplified profit and loss statement here. We have sales and revenues of $650,000, cost of goods sold $250,000. We are taking the sales and revenues minus our cost of goods sold to get us a gross profit of $400,000. Now remember, gross profit is what's left over after our direct costs, which are cost of goods sold, are paid for, and it's what's left to pay for everything else. So they have some operating expenses of $285,000. We subtract that from our gross profit to get our operating income. Then we have taxes and other additional expenses of $15,000, which we subtract from our operating income to reach our net profit for ABC Cooperative for the year 2023 of $100,000. Obviously, this is a simplified example, but all this information would come directly from your profit and loss. So ABC Cooperative only has worker owner employees, so all of the net profit can be attributed to the worker owners. This is important because not all cooperatives are only made up of worker owners. Some have just regular employees who are non-worker owners. So if ABC Cooperative had non-worker owners, which were just employees, then the net profit would need to be split between the amount generated by non-worker owners and the amount generated by the actual worker owners. So this goes back to kind of our bookkeeping point that you would need to make sure your bookkeeping when your payroll was being generated was done really well to indicate hours for non-worker owners, and for worker owners. So you would figure that out if you had those two classes of people, figure out how much of the net profit was attributable to the worker owners, and that's the figure we would move forward with, okay? Profit generated by non-worker owners would just go back into the cooperative, and it would not be distributed to the worker owners. It would stay within the company, okay? Okay, so now let's get into some specifics about ABC Cooperative's bylaws that are going to dictate how patronage is calculated and how it's paid out. So in ABC Cooperative's bylaws, it states that 25% of any net profit would be retained by the cooperative. So I want to pause right there and say this is one of the things that cooperatives write into their bylaws often, as they know they can't pay out everything. They still have to have operating income and ongoing, cash to operate. So this is a common thing in bylaws that a certain amount of net profit will be retained to continue operations, okay? So if 25% of the net profit will be retained, the remaining 75% will be distributed to the worker owners, okay? When distribution is made to worker owners, federal law states at least 20% must be paid directly to the worker owner in cash. This is so that the worker owner can cover the taxes for the entire distribution. We're going to go over some specifics about taxes in a minute, but that's very important to know. The fact that 20% of the patronage needs to be paid out in cash is directly for tax-related purposes. The remaining amount, so The other 80%, let's say, that would be non-cash distribution, will be held by the cooperative in that worker-owner equity account. It says it can accrue interest at a rate listed in the bylaws. Again, that's going to look different for each cooperative. It may have accrue interest, it may not accrue interest. Also, I want to point out, these worker-owner equity accounts aren't just like a bank account. The worker owners can't just tap into the money as they see fit. There should be something in the bylaws that explain how and when a worker owner can access that equity. Generally, it's when they leave the co-op, and there's usually rules on how much that can be paid out over time so that the cooperative is not under any a hardship of paying out a worker owner. So again, those types of things are dictated by the bylaws. That's not to say that a cooperative wouldn't decide that if a worker owner needs to tap into that equity, that maybe they could get a portion of it. Maybe they want to buy a house or something. Those are all specific to the cooperatives and their bylaws and what they've determined is acceptable. So let's go on with our calculation here of our example. So again, we know that 25% of the net profit is going to stay within the cooperative. That's just the rules that this cooperative has set up. So let's take our example. We have net profit of $100,000. And as I already mentioned, the only employees in this cooperative are worker owners. So we can use that entire $100,000 in our calculations. So the first thing we have to do is decide how much is going to be retained right off the bat, and that's $25,000. So now the number that we're looking to provide to the worker owners is known as a surplus. It's an amount above the profit that can be distributed to the worker owners. And again, it's a surplus because the worker cooperative has decided that they will keep 25% of the net profit and the rest is surplus to be given as patronage. So moving forward in our calculations, $75,000 of this surplus will be given to the worker owners. We don't know how yet. Might be cash, might be held within their equity account, but we're going to find out. Okay, once again, probably the third time I've said this because it's very important. Federal law states that at least 20% of a patronage distribution must be paid to the worker owner in cash so that they can cover the taxes for their entire distribution. Okay? So we know we have $75,000 that we need to distribute, and the cooperative has chosen to only give the 20% in cash. The rest will be held in the cooperative. This is also something that will look different on each cooperative. Some cooperatives choose to pay out more in cash if they can, so that not only can the worker owner pay their taxes, but then they have some cash. Once again, the bylaws are going to dictate all of these specifics. So in our example, though, this cooperative has decided 20% will be paid in cash. So right off the bat, we know $15,000 is going to be cash that the cooperative has to pay out. The remaining $60,000 of our $75,000 is going to be held in those owner equity accounts. So we have two things happening. We have a $75,000 total that needs to be distributed, 20% in cash, 80% held in the cooperative. Okay? So here's just a visual of exactly how this is going to work. ABC Cooperative in the yellow box is keeping 25,000 of the surplus of the profit, right? Because they've written that in their bylaws. So that will be the amount that goes over to retained earnings of our 100,000. That leaves 75,000, right? Well, that is the amount that's getting split up into retained patronage in the worker owner equity accounts, also being paid out in cash. Remember, we have to give them at least 20% in cash. So our $15,000 is cash payment, with the remaining 60 being held in the cooperative in the worker owner equity accounts. Okay? That is assumed to be paid out at some later date, but not any time in the near future. Okay? So again, we started with 100,000, 25% is retained. It goes from net profit now to retained earnings. The remaining 75% is being paid as patronage dividends. part in cash, 20% per the IRS rules, the remainder in the member or worker owner equity accounts. Let's see how this looks for each worker owner though. So we have, if you recall, the way the worker owner's patronage individually is determined is on their hours worked, because in a worker cooperative, that is their involvement in the co-op, is they're working there. And so their hours are what is used to determine their amount of that patronage. So now remember, we have a total of 75,000 to divide up, part in cash, part retained, but 75,000 is the total number we're giving to these 5 employees. Okay, so on the left-hand side, we have some information. We know the total patronage is at 75,000. Once again, our profit was 100,000. The co-op keeps 25% automatically. The remainder goes to the worker owners. And so it looks like those 5 worker owners over the course of a year worked 6,000 hours. And there's the breakdown. There's a couple different rates there, right? Worker owner 1 worked the most and will get the biggest share of the patronage dividend. Worker owners 4 and 5 worked the least, but they will still get a percentage equivalent to what they worked. So let's look at what that breaks out as. Once again, I've only brought the section that we are directly looking at here, which is that $75,000 total patronage dividend paid out. Part in cash, part retained. And this table explains that. So notice across the top, we have our retained patronage, which is 80%, cash payment 20%, for our total patronage of $75,000 down there in the bottom right-hand corner. So that looks a little different for each worker owner, right? Their cash payment, well, their total patronage is based directly on their number of hours. So for example, worker owner 1, 33% of the 6,000 was attributable to them. So 33% of the 75,000 total patronage is what their total is. That's further broken up, right? 20% cash, 80% retained. So each worker owner is going to get a cash payment that is 20% so that they can pay tax on this entire total patronage amount, which is what they will be required to pay tax on. Let's talk a little bit about taxes. So I want to point out this is all information that I have gotten from resources that are located in this presentation and in the PDF you'll get. But if you have questions, you definitely want to ask a CPA who understands about subchapter T, which is an IRS tax code directly ruling over cooperative businesses. So while this information is great, I know this can be confusing, so please refer to a CPA if you have specific questions on how this will work in your cooperative. But here's some basics, and here's some tax implications for the cooperative itself, because, right, we're looking at this from 2 angles, from the cooperative business standpoint and from the worker owner standpoint. So a patronage distribution, can be qualified or non-qualified. And essentially what that means is qualified would refer to whether the patronage distribution is tax deductible to the cooperative in the current year or not. That's the main point. So, a couple things. Cash patronage is always considered qualified and is always tax deductible to the cooperative. So that's in the cooperative's benefit. When you have the retained patronage, it can be either or, either qualified or not. If it is qualified, it's taxable to the cooperative in the year it is distributed. If it's non-qualified, it's tax deductible to the cooperative in the year which it is redeemed, meaning you'd have to look at the bylaws for the rules on a worker owner redeeming their patronage. And that, whenever that time period is based on the bylaws, that is when it would be tax deductible. Again, qualified or non-qualified. We'll get into that in just a minute too. So when a cooperative issues non-qualified retained patronage, they pay taxes on that income in the year of the distribution, so on the income part, then they get a deduction when the equity is redeemed. Again, this can be complicated and confusing, These are just basics of tax implications. Please refer to a CPA for specifics. So, for the cooperative to make a qualified patronage distribution, these 4 things must be met. It must be made within 8 months from the end of the tax year in which the income occurred. If it's not, it would be non-qualified. 2, the worker owner must receive written notice of allocation. That should be happening anytime patronage is being distributed. The worker owner needs to receive written notice. 3, at least 20% of the total distribution must be in the form of cash. Once again, that's a point that makes it qualified. And 4, the member must consent to include the patronage on their tax return as ordinary income. Again, well, we're going to look at it in a minute, but that is important as well. That cash distribution is supposed to be helping the member, or the worker owner, pay for their tax. Okay? Now, let's talk about the worker owner. And again, these are basic rules. If you have questions as the worker owner, definitely talk to a CPA. So patronage to the worker owners can be in the form of cash or retained equity, right? We've discussed that. So each member will pay tax on the patronage dividend distributed or allocated to the worker owner. The worker owner must pay income tax on the entire patronage amount, even if some of it was retained. That is why that's the rationale behind the 20% cash rule from the IRS, so that the worker owner will have enough cash to pay taxes on their entire patronage amount. This also varies from state to state as far as income tax, so that's why you should definitely refer to a CPA before your co-op is even getting ready to distribute patronage. And hopefully when you were setting up your co-op, an attorney and a CPA helped you go through the bylaws to make sure that they made sense and adhered to some of these rules. Okay. Worker cooperative cash management is critical. Worker cooperatives, just like other businesses, need to be profitable. And so the structure of how patronage is handled is really beneficial to the business, to the cooperative. It avoids double taxation because patronage is not subject to the corporate income tax. It's at some point deductible to the co-op, whether that is because it was cash or because they paid tax on it and then it was retained and they got a tax break when that was finally distributed. So either way, it really is tax beneficial to the cooperative. It helps to keep cash in the cooperative because they're not required, like a traditional corporation, to pay shareholders a certain amount per year. They can keep some of that in the equity accounts. And so it helps keep cash in the cooperative longer. And member capital accounts can kind of be saving mechanisms, you know. The bylaws are going to determine how the worker owners can access that. But, you know, after a certain amount of time, that can build up to be something really beneficial for their worker owner. So again, if you have more questions on this, talk to a CPA, but it's important to at least understand the basics of how this works. Even if you weren't involved in the creation of the bylaws, read your bylaws. Find out what the patronage rules are for your specific cooperative. Here is a long list of resources if you'd like to get more information on any of this. I do like Investopedia.com. It's very user-friendly and can give you lots of definitions on many, many financial terms and ideas, and I really recommend using that. A couple of our great other institutions, Cooperative Development Institute, Cooperation Works, Democracy at Work Institute, all have really good information. There's some specifics in here about subchapter T and more about taxes. And then down there at the bottom is that textbook that I pulled those examples from. If you want to take a look at that, you can find that. And then I also want to note that we have a ton of definitions. Also, you can find those in the PDF to this to just help you with some of the terms that I went over. If they weren't explained very well, I apologize, but definitely reference that information. And just thank you so much for watching this and for helping to be part of making the ecosystem for cooperatives really robust in Arizona. We thank you so much, and we look forward to seeing you at another event or something else. Thanks.